There's been a lot of talk about an upcoming economic recession, so in this video I'm going to cover 5 ways you can invest during a recession to keep your portfolio in the green. Recently, FedEx's CEO says he believes a recession is impending for the global economy. There have been talks of inverted yield curves and inflation and bear markets for a while now, so it may be a good idea to have some ideas of where and what you can invest in during an economic downturn. But remember, I'm just a goofball on YouTube, so the following ideas are just that, ideas. Only invest in things that you understand and feel comfortable with. I'm not a financial advisor. And thanks to TradeStation for sponsoring this video. First up are Series I savings bonds. Now, bonds are typically known for being a safe, low-interest way to balance out a portfolio, but I bonds are particularly interesting because the interest rate you earn is linked to the inflation rate. Here in the US, the inflation rate as of September of this year is 8.3%, down from June's high of 9.1%. But you can currently buy I bonds at a rate of 9.62% until October, when a new rate will be set. You lock in 9.62% for 6 months from the time of purchase. The Treasury will set new rates in November and May based off of the Consumer Price Index, but the change is only applied to your bond every 6 months from the bond's issue date. Now, there are a few caveats. First, you are maxed out at investing $10,000 per year in these bonds. Second, you have to own them for at least 1 year. But if you cash out before 5 years, you forfeit the interest from the previous 3 months. So ideally, this is a longer term hold in your portfolio. The savings bonds themselves are exempt from taxation, but interest earned is subject to federal income tax, because of course it is. Now, to buy them, you're going to use this Web 1.0 looking government website.
You've got mail.
But it'll get the job done. In case you aren't familiar, the VIX index measures the market outlook for volatility based off the S&P 500 stock index option prices. Some people refer to the VIX as the fear index. Typically, if the market tanks, volatility rises. Look at the COVID crash in March 2020. VIX's support line for months prior was around 12, and at its peak in March, it hit 85 for a 600% increase. Now, of course, you're not going to have perfect entries trying to time the market, but I would be interested in VIX around the 24 level if I expect the S&P to continue to drop. So I mentioned call options. If you are new to options trading, well, I would probably just skip this one altogether, but with calls, you're making a directional bet that the underlying, in this case the VIX, will increase in price. But these options contracts could also expire worthless if we're wrong, so keep that in mind. We also want to make sure these contracts have plenty of time on them before they expire. Right now, I could buy VIX calls expiring in March of 2023 with a $23 strike price for $700 a piece. That is essentially saying that VIX will be at least $23 by March 22nd of 2023. But because option pricing is somewhat complex, for this to be profitable, I need the VIX to be over $30 in March. Anyways, call options could be a decent hedge for a portfolio if continued selling in the market is expected for the short term. Now in the finance space, a lot of platforms and brokers have wanted to sponsor a video, but I've turned them all down until now. TradeStation is an equities, options, futures, and crypto broker, one of the few independent direct access and self-clearing brokers in all major asset classes. They have top-rated mobile and web applications, which makes it easy for a beginner as you learn to invest, but still has all the features advanced users rely on. One of my favorite features is its integration with TradingView, so if you love TradingView for charting, which I do, you can trade directly from those charts with a TradeStation account. And if that wasn't enough, there's commission-free trading available for stocks, ETFs, and options, and competitive pricing on futures and crypto. TradeStation was started almost 40 years ago and was one of the first to offer a decentralized trading platform, and at its heart, it's a fintech company developing their own applications, APIs, and execution algorithms. If you want to check out TradeStation for yourself, you'll receive $150 as a new client when you open an account with this promo code. And you just need a $500 deposit to get your paws on that promo. So to learn more and sign up, check out tradestation.com/Daniel Inskeep, or just click the link in the description. In a similar vein to VIX call options, you could forget about the VIX altogether.
Cut out the middleman
And go straight to shorting the S&P 500. You could do this by selling short an S&P futures contract, by buying put options on an S&P 500 ETF like SPY, or by inverse ETFs. My favorite of these is buying put options on SPY. Because an increase in volatility causes an increase in the cost of an options contract, ideally you want to buy before a major decline. If you buy during a large drop and then volatility decreases, you could still lose money even if the market continues to decline. Now this gets into the timing the market territory, which is dangerous, but you could buy a small amount of SPY puts as a hedge in your portfolio. Again, let's look at SPY puts expiring next March. You could buy puts with a strike of $409 for about $4,100. This can be an expensive hedge depending on the size of your portfolio, but if the market were to drop to June's low of around $365, you would make roughly 15% if you sold in March. Hi, it's me from the future. I filmed this video 2 days ago, and since then, that contract I was just talking about was about $3,400. And then the market dropped yesterday after the FOMC meeting. You would make about 38% on that contract if you bought 2 days ago, as opposed to now where it's about 15%, which is why buying puts after a major drop may not be the best idea. Okay, let's go back to old me. Remember, it's risky, but if you like to actively manage your portfolio, this is a viable option. Pun intended. If you've always wanted to buy the dip, but have a hard time pulling the trigger when the market is dropping, you could consider writing put options. Let's say you want to load up your portfolio with 100 shares of Apple, but Apple is hovering around $154 and you think that the market is going to continue to drop and you would rather buy Apple at a lower price. Well, you could create a limit order at, let's say, $142. And if the stock ends up going down to $142, you'd be the lucky owner of 100 shares of Apple when your order executes. Now, alternatively, let's consider selling, or writing as it's called, a put option on Apple instead of placing a limit order. We could sell a put option for $259 expiring next month. That $259 goes into our hypothetical pocket. Now, at any time, the counterparty, aka whoever bought the put contract from us, can make us buy 100 shares of Apple at $142. But that's fine with us. That's what our original goal was. But now the benefit is we get to keep the $259 in premium that the buyer paid us for that contract. This effectively lowers the cost of Apple shares to around $139.41 a piece. Of course, to do this, you need to be able to afford the 100 shares of Apple at $142, so that cash will be tied up until the option expires or is exercised. And if Apple never drops to $142 and the option contract expires worthless, well, we just made $259. So essentially, it's almost like placing a limit order, but you get paid to do it. Now, it's more complex than that, but if this sounds interesting to you, I recommend you research writing put contracts further. Okay, enough stock market talk. Let's look at investing in real estate during a recession. Just because the stock market is dropping or there's a recession doesn't automatically mean real estate prices are going to drop, but it can definitely help cool off a hot housing market, which is exactly what we've had the last few years. Single-family homes, condos, duplexes, triplexes, fourplexes, or apartment buildings can all make viable rentals if that's something you're into. The downside is that interest rates are usually higher at the beginning of a recession, so borrowing money becomes more expensive. When we bought our house a year and a half ago, we locked in a 2.75% interest rate. Now the rates are over 6%, which has a huge impact on the affordability of real estate. At some point, the Federal Reserve will adjust their rate policy to encourage spending and borrowing, and ideally that will coincide with lower real estate prices, and that's when you can buy. Rental properties can be a great investment during recessions because rents don't normally drop during recessions. Sometimes it just increases demand since fewer people can afford to buy homes and are forced to rent. Another sector of real estate investing to consider is self-storage. In 2008, when some real estate sectors had 60% losses, self-storage saw a 5% gain. People love their stuff and they gotta store it somewhere, especially if they downsize their home. So those were 5 different methods to consider during a recession, but the smartest thing for you might be to do nothing. If you are relatively young, there's no reason to panic during a market downturn. You don't need to freak out and sell your portfolio. You can just sit on your hands and wait for the market to rebound. Thanks for watching. It's good to be back.